Good afternoon, everyone, and welcome to our weekly webinar where we're going to talk about what we see happening in the global economy and in financial markets and other wealth management situations, and one in particular that we want to address today. But what it is all about is how we make decisions on the best courses of action for your portfolios and your strategies, and the big picture wealth management that we're looking after for our clients. So thanks for taking the time today, taking the time out of your busy schedules to join us. We're recording this so that those who can't join us live can tune in when it's more convenient. I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock, and also on the call is our financial planner, Bianca Tomlinson. We will have a Q&A at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to jump in and ask questions. Well, today I am live from beautiful Georgian Bay, just north of Parry Sound, Ontario. I may be away from the office, and I am for a couple of days, but I'm always on top of things, monitoring global developments and, of course, your portfolios. And Paul and Bianca are at our home office at number 1 Toronto Street. So, but we're always focused, so we want you to be well aware of that. But how beautiful it is up here, I'll tell you that right now. And it's lovely to be able to look out onto the bay while we're doing this webinar. As most of you know by now, but for the benefit of some of our newer listeners, High Rock was founded by Paul in 2010 to manage a series of closed-end funds for Scotiabank. We're registered with the Ontario Securities Commission, which is an agency of the province of Ontario. Well, around the world, the media has been focused on this gentleman, Mr. Blatter, and the ongoing issues with FIFA. But closer to home, the media has been focused on High Rock. Why? Because we are leading the revolution for transparency so that investors can fully understand what their costs are. Now, our private client division, which was established to take advantage of some of the synergies that we derive from the $200 million that we manage for the Scotiabank funds. But what's important is that we're not brokers. We're not investment advisors. We're not financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Most financial advisors are not paid to manage money. They're paid to gather assets and find a mutual fund or third-party manager to place your money with. In fact, many advisors place their client money with High Rock. And this means that they are paying fees on top of fees. In essence, our private client group and the rationale behind it is intended to try to take out the middleman and try to save our clients' money. So, as I said, most advisors are not necessarily telling you what the hidden costs are. And those hidden costs can potentially erode can erode the potential growth of your money. And what we want to do is be upfront in telling you exactly what you're paying for. Our clients don't own mutual funds, but if you do own mutual funds, you're paying a mutual fund manager a management fee. You may also be paying your advisor either directly or indirectly because the mutual fund company might be paying the advisor as well. So the advisor may be getting money from you as a client, plus they may be getting money from the mutual fund company. At High Rock, that doesn't happen. We have a very specific management fee. We do use our synergies and our scale to try to find a way to have as much of our investments in assets that we manage directly. However, when we want to get broad and diverse exposure to global equity markets, we will use exchange-traded funds, and there are expenses attached to those, but we work very diligently to try to keep those expenses as low as we possibly can. And that's it. Our fees are simple, transparent, complete. And what we think is extremely important is that our clients are aware of that you're getting full disclosure. And this is above and beyond what the regulators tell us we have to tell you. There is new legislation coming. The article in today's Financial Post addresses that. And again, we think that even the legislation that's coming, the increase in transparency is still not 100% to investors' benefit. So that's something that article is about. And if you have a chance, check out the Financial Post today. Check out Barry Critchie's column and learn a little more. And maybe if there's questions, obviously feel free to send us an email. Why do we think this is so important? Well, we know that over longer periods of time, it can make a fairly significant difference in a portfolio. If we can cut the costs down to the minimum, I mean, we still have to get paid, of course, for doing our work, but if we can cut our clients' costs down to the minimum, it just means that over time, with compounding, you can grow your money at a much better rate, and it does make a difference, as you can see from this chart. Okay, so let's get on with our economic themes. Of course, we've been talking about these on a regular basis, but we're going to focus today just on a couple. But one of those is inflation or deflation, and that's a big question right now. And yesterday we saw some data from the U.S. Federal Reserve. As we mentioned last week, the key data that the U.S. Federal Reserve targets for U.S. inflation is the core personal consumption expenditures, or PCE, price index. Yesterday, the data showed a fairly benign 1.2% year-on-year increase, which is lower than what we were seeing last month. So we're actually seeing some decline in this particular rate. Now, obviously, it's well below the Fed's 2% target, but what's important here is that with all things being equal, it gives the Federal Reserve breathing room for its timing on an interest rate increase. And at the moment, or up until yesterday, most market participants in the financial markets were expecting a September increase. That could possibly be pushed back if other economic data continue to show slow economic growth. I'll talk about a little bit of our theory about the consumer in just a minute, but we also saw some consumer data yesterday as well, and that could actually be significant as far as economic data that continues to show that we're not seeing much of a pickup in the U.S. economy, and that may, in fact, give the Federal Reserve, the U.S. Federal Reserve, some pause in contemplating what they're going to do as far as interest rates are concerned. In Europe, we did see a slight uptick in inflation, but as you can see before in the past, we've had 1 month upticks in inflation, but it doesn't necessarily mean the trend is changing. It does mean that we have to pay some attention, and of course we will, to watch what's going on to see if this situation continues. But again, at the moment, I think there's still lots of breathing room for the European Central Bank as far as their policies of continued quantitative easing and very stimulative monetary policy. Okay, so another one of our themes is that the global economy is expecting that we're going to see the U.S. economy in the second half be the economic growth that everybody's counting on to pull the global economy along. Well, the last couple of days we've seen some interesting information about the consumer. Historically, the consumer has been approximately 2/3 of the U.S. economy. But not only are we seeing consumer sentiment start to slip, but we're also starting and have been seeing consumers not spending money the way they did in the pre-2008 era. Obamacare certainly is one of the issues that has thrown a wrench into the works of the U.S. economy and what the consumer is thinking. But there are other schools of thought out there that are thinking that perhaps there's more of a structural and demographic adjustment going on. You know, baby boomers are retired or saving for retirement. And the millennial generation, the kids of the baby boomers, which is now becoming the biggest cohort, is in fact not consuming or spending the same way that their folks did. So we think that there's some potential significance here for both the U.S. and the Canadian, and of course in a longer term perspective for the global economy. I'm going to throw up a chart here. A demographic chart, and this is something that we think is a pretty important theme, and I'm going to actually ask Paul to come in and sort of speak to this a bit.
Thanks, Scott. This chart is from StatsCan data, and if you look at the orange parts of the bar charts, that's the 45 to 64-year-old cohort, and if you look at the black or gray parts of the bar chart, that is the 65 plus cohort. So as you can see, and this is as far out as StatsCan data goes, out to 2036 or so, that 65 plus cohort expands rather dramatically. And the implications for all of us, and most certainly for capital markets, financial markets, stocks, bonds, etc., is quite simple. As you age, and as Scott said in the previous couple of slides, you probably consume less. You start saving more. You're on a fixed income. You don't have you may have retired, so you don't have a steady stream of income coming in from employment. You may just have a smaller stream of income coming in from your retirement investments. So you spend less. And the other thing you need more of is fixed income to drive that natural cash flow. So you need more bonds in your portfolio, and pension funds need to immunize or match the assets to the liabilities, so they need more bonds. That's a very structural change in the bond markets that we follow. And the other thing you need less of as you age and turn 65 plus is less volatility. And typically we see in capital markets more volatility in stocks than bonds. So we do see a change that's been occurring over the last number of years, and we think it's a very long-term trend towards more demand for fixed income and slightly less demand for equities.
And Paul, the implications that presents, obviously, for our clients and for us as portfolio managers are that we have to take these situations into consideration, understanding that if there is a greater degree of volatility, we need to protect our clients from that volatility. And as you said, perhaps there may be a shift to more towards fixed income. Okay, so let's now move on to talking about our portfolio models. Fixed income prices have been a little bit less volatile over the last few weeks. We have not been involved in fixed income markets recently, as we have suggested. When fixed income prices were more volatile and hit lower levels, we were doing a little bit of buying for our portfolios. But over the last couple of weeks, we have not been doing any buying. We will look to add, if we do get lower prices, higher yields. But at the moment, we have been a little bit quiet on this front. As far as our global equity models, once again, we've talked in the last number of calls about our concerns that equity prices remain expensive. We will continue to be cautious with our global equity models as far as adding to positions. We continue to look for opportunities to move clients out of more expensive ETFs and into lower cost ETFs. That is one of our mandates. And as I suggested earlier, something that's very important to us on the transparency front. So that's definitely something that we will continue to be working towards. As far as our growth, Canadian growth equity portfolio, I'm going to flip that over to Paul, but we've had some nice developments with one of the assets that we purchased a few weeks back, and I'll let Paul talk to that. I'm just going to pop up a chart for him here.
Yeah, thanks, Scott. The chart you're looking at is Air Canada stock, which we bought 2 weeks ago. The day they reported their numbers, we bought it almost at the bottom of that day where you see it just above the red arrow where it gapped up a little bit at 12.17. And this morning we monetized or sold half of our position at 14.60, and I think the stock closed below that. It also traded higher. The stock closed at 14.38, but it traded up to 15.09, and part of our mindset in this stock is pure value, but also and these airline stocks. First of all, Air Canada trades very cheaply to the U.S. mainline carriers. Number one, on a valuation basis, and number two, the whole world, I think, is underinvested in airline stocks because they've historically been extremely volatile. But a lot of the balance sheets have been cleaned up, pension situations have improved. Those were the two main problems, and they ran into cyclical problems. So it's a very much an improving situation. So our plan here is to buy back some of our position. We had a nice little pass, buy back some of our position at slightly lower prices. I just feel like it's a little bit overdone today. They had it was an all-morning annual investor day. And we were on the call via webcast, and there was obviously some very positive things that were said, but it's a little bit of buy the rumor, sell the fact. We bought two other positions that are very small, and one of them we will look to add to, but we're not in a rush. And there we have 15 names that we look at and know well, but quite frankly, the rest of them, Scott, are just too high a price and too high a valuation for us right now, so we're waiting for more of a sell-off similar to the global equity model.
All right. Well, thanks, Paul, for that. Appreciate getting a little insight here, and it was.
Scott.
Sorry.
Scott, I would just add on that trade over a 2-week period, we're up about 20%, which I think if you annualize that, it's up. Be up somewhere around 400 or 500%, but that's a pretty good move over 2 weeks. So we are pleased with it.
And as you said, we've taken some off the table, but we're still going to maintain a core position in this particular holding. All right. Well, that's pretty much it for today's discussion. I want to thank Paul for his insight here, but I'd also like to open up the floor to any questions. If anybody on the call would like to chime in, please feel free. It doesn't have to be anything we've necessarily talked about today. It could be any question at all on a portfolio management, wealth management, or even on the economy. Okay, well, it sounds like everybody's got all the information they need for now, but as always, if anybody comes up with a question over the course of the week or before we get together again next week, please don't hesitate to send us an email or give us a quick call. We're really always happy to answer questions and make sure that we're being as communicative as possible with our clients. Okay, that's it for another week. Thank you for taking the time to tune in. Have a great week. And we will be back with another edition of the High Rock webinar Tuesday series next week. And once again, have a great rest of the week.